Hey, before we jump in, this deep dive is brought to you by CertFuel. If you're studying for the Securities Industry Essentials exam, they've got a full SIE course with adaptive study quizzes, smart flashcards, and unlimited practice exams weighted exactly like the real thing.
Yeah, it's pretty incredible.
It really is exactly what you need to stop guessing and start passing. Check it out at certfuel.com. All right, let's get into it. So, if you open up your brokerage app right now and you buy a stock at $50 a share, and then tomorrow morning you wake up, you check your phone and see that it shot up to $70.
Oh, the best feeling in the world.
Right. The green numbers are flashing, the chart is pointing straight up. But I want to ask you, the listener, how much money did you actually make? Seriously, think about it for a second.
Most people would just yell, 20 bucks.
Exactly. But the reality, you haven't made a single dime. Today, we are going to completely dismantle the illusion of paper gains.
It is so easy to fall into the trap of looking at finance like a simple machine. You know, money goes in, the number goes up, you point at the screen and say, look, I'm a genius, I made money.
Right.
But then you step into the world of securities regulation and investment returns, and especially taxation, and suddenly that clean binary machine is completely broken.
Oh, it is the absolute definition of muddy waters. Because in the securities industry, making money isn't just about the number getting bigger, it's about how it got bigger, right?
Yeah, and when exactly it got bigger?
Yes, and precisely how much of a cut the IRS is going to take before you can actually go out and, buy a sandwich with that money.
Welcome to the deep dive. Today, we are talking directly to you. Yes, you, the person listening right now, walking the dog, commuting to work, or maybe just staring at a wall trying to conquer the Securities Industry Essentials exam.
We know how tough it is. We really do. Let me set the stage and give you the mission for today's dive. We have piled up a massive stack of sources on the table in front of us. We've got the official FINRA is SIE exam syllabus, historical tax code changes from the IRS, SEC rulings on market settlement timeline.
Tons of regulatory paperwork.
Tons of it. Plus, a whole bunch of adaptive study notes from CertFuel. Our mission is to synthesize all of this and help you master investment returns. Because look, this topic makes up a massive 31% of your test.
That is huge.
That's 23 questions standing between you and your career.
It really is the bedrock of the entire industry. I mean, the securities industry at its core is entirely based on measuring what you earn, when you earn it, and how the government taxes it. If you do not fundamentally understand the mechanics of returns, nothing else in finance, not options, not mutual funds, not retirement accounts, is going to make any sense.
Exactly. And look, I know some of you out there might have ADHD or maybe standard dry lectures just lose you fast. I get it. You read a textbook paragraph 4 times and realized you were thinking about what to have for dinner the whole time.
We've all been there.
So we're going to keep you locked in today. We're going to make this stick using ridiculous analogies and absolutely zero dry textbook speak. And to help us do this, I want to introduce you to the cast of characters who will be starring in today's chaotic financial scenarios.
I love these guys.
You are going to be hearing a lot about these 3. First, we have Dolores, the dividend hunter.
Dolores is fantastic. She loves cash. She hates selling her shares. She tracks every single penny that comes into her mailbox, and she views her portfolio like a golden goose.
Right. She never wants to kill the goose.
Exactly. Her entire goal in life is to never kill the goose, but just keep collecting those golden cash eggs.
Next, we have Discount Dave. Dave is the ultimate cheapskate. He is always looking for a bargain. He refuses to pay full price for anything.
If a bond isn't sitting on the clearance rack trading below its par value, Dave is walking away.
He's out of there. And finally, we have Cautious Carl. Carl is terrified of the IRS. I mean, he tracks his paperwork obsessively. He color codes his spreadsheets.
But he gets confused easily by complex rules.
Yeah, he needs everything explained slowly, logically, and with a clear focus on how to not go to jail for tax evasion.
Carl just wants to stay out of trouble.
All right, let's start building the foundation. Before we can track performance, before we can even begin to measure how well Dolores or Dave did this year, we have to define what a return actually is. Because you can't measure a race if you don't know where the finish line is. So what mathematically makes up an investment return?
It basically boils down to a dual nature. Every investment return is made of 2 distinct components. You have income and you have capital changes.
Okay, let's break those down.
Let's start with income. Think of income as the money paid to you while you were just sitting there statically holding the investment. You aren't doing anything, you haven't sold anything, but cash is actively being handed to you by the issuer.
Just mailbox money.
Exactly. Capital changes, on the other hand, refer to the changes in the actual market value of the thing you own.
Okay, so let's bring in Dolores, the dividend hunter, to illustrate the income side. She buys a corporate bond. Because she is lending money to that corporation, she gets interest.
Yep.
Right. Let's say it's a 5% semi-annual coupon. She gets a check in the mail every 6 months. That is income.
Perfect example.
Or she buys a stock, taking ownership in a company, and the company shares its profits with her in the form of dividends. $2 a share, paid out quarterly. Again, cash in hand. Dolores is thrilled. That is the income side. Very straightforward.
Yeah.
But what about the capital changes side? You said the value of the asset changing.
Capital changes are where people get tripped up and where test writers love to lay their traps. We have to split capital changes into two rigid categories: realized and unrealized.
This is huge for the exam.
It's critical, and understanding the psychological and legal difference between these two is everything. Realized means you actually sold the investment. The transaction is complete. It's over. You bought a stock at 50, you sold it at 70, you have a realized capital gain of $20.
The cash is locked in.
It is locked in, and the IRS is now very interested in you.
And unrealized. That goes back to the question I asked at the very beginning of the deep dive.
Precisely. Unrealized means you are still holding the asset. You bought at 50, it's currently trading at 70 on the open market, but you haven't sold it. The market is basically shouting at you, hey, I'll give you $70 for this right now.
But you haven't taken the deal.
Right. Until you accept that offer, you haven't made anything.
Okay, you, the listener, I'm asking you directly again. Think about the psychology here. If you buy a stock at $50 and it jumps to $70, why does the IRS not care? Give it a second.
Think about the legal transaction.
Because you didn't legally finalize the gain. You made absolutely $0 in the eyes of the law.
Exactly. Until you hit that sell button, you haven't made a dime. This is what we call a paper gain. It only exists on paper or, on your screen.
It's a fantasy.
It is. The market could crash tomorrow and that stock could plummet to $30. If you didn't sell at 70, that unrealized gain vanishes into thin air. The IRS only taxes reality, not potential.
The test writers absolutely love this misdirection. Your alarm bells should be ringing if you see a question that sets up a wildly elaborate scenario. For example, Discount Dave buys 1,000 shares of a tiny biotech company at $20. The company miraculously cures the common cold, the stock goes parabolic, and skyrockets to $150 a share.
Oh, they love painting that picture.
And then the question asks, what is Dave's realized capital gain? Listen to me. If the question does not explicitly state that Dave sold the stock, the realized gain is zero. It is purely an unrealized paper gain. Do not let the dramatic storytelling trick you into doing math that doesn't exist.
That is a perfect example. They will try to excite you with massive price movements to make you forget the fundamental rule. Always ask yourself, did the character sell? No sale, no realized gain.
Boom. So we have income, which is cash paid to you, and capital gains, which only happen when selling for a profit. But here is where we get to a really fascinating mechanism in the world of distributions. There's a weird cousin that hangs around the portfolio. It's called return of capital. What is happening here?
Return of capital is a brilliant concept to understand because it looks like income. It feels exactly like income when it hits your bank account, but the IRS acknowledges that it is absolutely not income.
Wait, if it's cash hitting my account, how is it not income?
Because of where the money is coming from. Sometimes certain types of investments specifically pass through structures like real estate investment trusts or REITs or master limited partnerships, MLPs.
Okay, REITs and MLPs, got it.
Right. They distribute money to you, but it's not coming from their operating profits.
Sure.
Due to things like massive depreciation on real estate, they are essentially just taking the principal money you originally invested and handing a piece of it back to you.
Okay, let's ground this. Listener, imagine you lend your buddy $100. A week later, he walks up to you and hands you a $10 bill. You didn't earn a 10% return. You aren't a brilliant financier. He just gave you your own money back.
That's it. Exactly.
Now, you only have $90 at risk with him.
That is the perfect real-world analogy. And because you are just getting your own money back, it is not taxable when you receive it. The IRS is very clear. You do not owe income tax on your own principal.
Okay, so that's good news for Carl.
It is, but, and here's the accounting reality that you must track, it reduces your cost basis. Your cost basis is the historical record of what you paid for the investment. In your analogy, your original basis was $100. He hands you $10 back. Your new adjusted cost basis is strictly $90.
Let's bring in cautious Carl. Carl is terrified of audits.
Mhm.
Carl invests $10,000 in a pipeline MLP. A few months later, the MLP sends Carl a check for $1,000, and the paperwork clearly classifies it as a return of capital. Carl starts hyperventilating. Do I owe taxes on this $1,000? I didn't set aside any cash to pay the taxman.
And you would calmly tell Carl, relax, put the paper bag down, no taxes are due right now. But Carl needs to immediately update his famous color-coded spreadsheet. His original cost basis was $10,000. He received $1,000 of his own money back. His new adjusted cost basis is strictly $9,000.
No, why does that matter? Explain the downstream effect to Carl, because there's always a catch.
Oh, because the piper always needs to be paid eventually. Let's say Carl decides to sell that MLP a year later, and he sells it for $10,000, the exact same amount of cash he originally put in on day one.
So Carl might smile and think he broke even. No harm, no foul.
Right, but he didn't break even in the eyes of the law. His basis was mathematically reduced to $9,000. He sold the asset for $10,000. The IRS looks at that and says, Carl, you have a $1,000 realized capital gain, and he will owe taxes on that gain at the time of the sale.
Boom. That is a massive concept to grasp. The basis reduction acts as a delayed tax mechanism. Now think about this scenario. What happens if Carl never sells? What if he stays in this MLP for a decade and they keep giving him return of capital distributions year after year after year?
It keeps dropping.
Yeah, eventually his cost basis is going to drop from $10,000 down to $5,000 down to $1,000 and then hit exactly zero. What happens the next time they send him a check?
This is a beautiful edge case for the exam. Once the cost basis is reduced to zero, you have mathematically gotten 100% of your original risk capital back.
Right.
You cannot have a negative cost basis in the tax code. So once your basis hits zero, any additional return of capital distribution you receive suddenly flips its identity.
It transforms.
Yes. It becomes immediately taxable as a capital gain in the year you receive it. You are playing with house money at that point, and the IRS wants their cut.
Man, the IRS does not miss a trick. So to quickly consolidate this before we move on, income is cash you get while holding. Realized gains only happen when you hit sell, otherwise it's an unrealized paper gain. And return of capital is just getting your own money back, which lowers your cost basis and sets you up for larger capital gains down the road.
Precisely. You are delaying the tax, not eliminating it.
Okay, let's pivot to the next major conceptual block. We just established that dividends are a core part of income. Dolores, the dividend hunter, lives for them. But dividends come in different flavors. What happens when a company wants to reward shareholders, but they do not want to part with their actual cash?
They pay in stock.
Let's compare the traditional cash dividend and the stock dividend side by side. Give me the rundown on the classic cash dividend first.
So a cash dividend is exactly what it sounds like. A corporation has a great quarter, they make a solid profit, and they decide to share a portion of that profit directly with the owners, the shareholders.
Okay, pretty standard.
But the most important mechanical detail to remember for the exam here is who actually holds the power to decide this. A dividend is declared exclusively by the board of directors.
Wait, if I own the stock, I am a part owner of the company. Why don't the shareholders get to vote on whether we get paid?
It comes down to corporate governance and logistics. Shareholders elect the board of directors to make high-level strategic decisions on their behalf. Distributing cash impacts the company's balance sheet, their ability to fund future projects, and their liquidity. You cannot have millions of retail investors voting on daily cash management.
Yeah, that would be chaos.
Absolute chaos. So the board decides. And once that cash dividend is paid out, it is generally taxed as ordinary income in the year you receive it.
Let me push back on that taxation point for a second.
Yeah.
Because I've read financial news articles talking about qualified dividends. And the way people talk about them, it sounds like some magical tax-free loophole.
I am so glad you brought that up because that is a classic misdirection. Qualified dividends, which generally come from domestic U.S. corporations, provided you have held the stock for a specific minimum holding period, get a preferential tax rate. Right. They're taxed at the same lower rate as long-term capital gains, usually around 15 or 20%, depending on your income bracket. But listen carefully. Preferential does not mean tax-free. You still pay taxes on qualified dividends. You just pay less than you would if they were taxed at your ordinary marginal income tax rate, which could be up to 37%.
Got it. So cash dividends equal taxable events, regardless of whether they are qualified or ordinary. And the board decides. Now, let's get weird. Explain the mechanics of a stock dividend.
Sometimes a company wants to reward its shareholders to give them a sense of value creation, but the company's executives look at the balance sheet and say, we really need to keep our cash in the bank to fund that new manufacturing plant or to pay down high-interest debt.
So they're feeling cash core.
Exactly. So instead of handing you cash, they hand you more shares of their own newly issued stock.
Okay, listener, I want you to picture a pizza. Just a classic, beautiful, greasy pepperoni pizza sitting on a table in a box. It comes out of the oven, and the chef cuts it into 8 even slices. Now, imagine the company declares a stock dividend. The chef walks out, takes his pizza cutter, and slices the pie again, turning those original 8 slices into 10 slices. Do you, the person eating the pizza, suddenly have more food?
You absolutely do not.
Exactly. You have the exact same total amount of pizza. The overall circumference of the pie has not changed by a single millimeter. You just have more slices in front of you, and mathematically, every individual slice is now slightly smaller and narrower. That is exactly what a stock dividend is.
The mechanics underlying your pizza analogy are vital for the exam. First, because you did not actually gain any new wealth, you just got your existing wealth chopped into smaller pieces. A stock dividend is not taxable when it is received.
Not taxable.
Right. The IRS looks at it and says, your economic reality hasn't changed. We can't tax you on this. Your total investment value stays identical. What does change, however, is your internal accounting. Your cost basis per share decreases.
Let's run the hard math with Dolores so this really crystallizes for the listener. Dolores buys 100 shares of a stock, and she pays exactly $50 a share. Her total investment value, her total cost basis out of pocket, is $5,000. Now, the company declares a 10% stock dividend. Walk me through what happens to Dolores' account.
First, we calculate her new share count. 10% of her original 100 shares is 10 shares. So the company drops 10 brand new shares into her brokerage account. Dolores now owns a total of 110 shares.
Does she owe the IRS any taxes on those 10 shiny new shares this year?
No, because her overall slice of the corporate pie hasn't changed. The total value of her investment is still exactly $5,000. But she needs to figure out her new basis per share so she knows how to calculate her taxes when she eventually decides to sell them down the road. To do that, you take the total basis, which is locked at $5,000, and divide it by her new, higher total number of shares, which is 110.
Let me literally punch that into a calculator right now. 5,000 divided by 110, that gives us $45.45.
Correct. Let's summarize her new reality. Her total cost basis is still $5,000, but her per share cost basis has dropped from $50 down to $45.45.
Okay, so if she wakes up tomorrow and decides to sell one single share for $50, she does not have zero gain. She has a taxable capital gain of $4.55 on that specific share.
Exactly. Because her per share basis went down.
Okay, I need a clear side-by-side comparison here because I feel a massive exam trap forming. We have stock dividends, which we just covered, and we have return of capital, which we talked about with Cautious Carl a few minutes ago. In both of these scenarios, you told me they are non-taxable when received. And in both scenarios, you told me the basis goes down. How does the listener tell them apart on a multiple choice test when the pressure is on?
This is one of the most common points of confusion, so let's separate them cleanly. Here is the ironclad rule. Yes, both are non-taxable upon receipt. But a stock dividend only decreases the per share basis, while your total aggregate cost basis stays exactly the same. The $5,000 stays $5,000.
Because I still bought the whole pizza for the same price, regardless of how many slices it is.
Exactly. Return of capital, however, decreases the total cost basis itself. If Carl gets a $1,000 return of capital, his total $5,000 basis physically drops to $4,000. To use your analogy, stock dividends change the number of slices. Return of capital literally shrinks the total size of the pie.
Stock dividends chop the slices. Return of capital shrinks the pie. I love that. Let's carry that forward into the next major hurdle. We're going to talk about the timeline trap, the acronym DERP, and the golden X date rule.
Oh, this is heavily tested.
So now Dolores knows what she's getting. She knows a cash dividend is coming, but she needs to know exactly when she has to execute her trade to actually secure the right to that dividend. Because if you mess up the dates by even one day, you get absolutely nothing.
The timeline of a corporate dividend is highly regimented. It is structured around 4 key dates. This sequence dictates the mechanical flow of money from the corporation's bank account to the shareholder's bank account.
I'm going to introduce the acronym right now, nice and loud so you don't forget it. DERP. DERP. Declaration X dividend, record, payable. Let's walk through DERP. What is the D?
D is for the declaration date. This is the day the board of directors officially raises their hand in a boardroom, looks at the public, and announces, we're officially declaring a dividend.
Making it official.
Right. They say, here is the exact dollar amount per share we are paying, and here is the date we will look at our record books to see who actually owns the stock. This becomes a legally binding liability for the company the moment they declare it.
Cool. Now, I'm going to intentionally skip the E for a second because we need to build to it. What is the R?
R is the record date. Think of this as the company's literal physical ledger book of all their shareholders. If your name is officially inked on that book at the close of business on the record date, you get the dividend check. If your name is not on that book, you don't get a dime. It is a binary snapshot in time.
Have a P.
Payable date. This is the easiest one. It's simply the day the cash actually leaves the company, the check's clear, and the money hits your brokerage account.
Okay, but we skipped the E. The X dividend date. Listener, stop what you were doing. If you are washing dishes, put the plate down.
Pay attention to this.
This is the most heavily tested concept in this entire unit. The X dividend date. What does it actually mean?
So X is a Latin prefix meaning without. Therefore, the X dividend date is the first day the stock trades on the open market without the right to receive the upcoming dividend. If you buy the stock on this day, you are buying it ex-dividend without the dividend.
And this ties into a massive fundamental rule change that recently shook up the entire financial industry, right? We need to explain why this date exists.
Yes, and the exam will aggressively test your knowledge of the new T+1 settlement rule. Historically, for a long time, stock trades took 2 full business days to settle. But effective May 2024, the SEC mandated that when you trade a stock, the transaction must legally settle 1 business day after the trade date, T+1.
Why did they do that? Why force everything to happen faster?
It was largely driven by a desire to reduce counterparty risk in the financial system. If you remember the crazy meme stock frenzy of 2021 with GameStop, brokerages like Robinhood had to literally halt buying.
Oh yeah, people were furious.
Right, but why did they do it? Because the 2-day settlement period meant clearinghouses demanded massive amounts of collateral to guarantee those trades over a 48-hour window. By shrinking settlement to T+1, the SEC drastically reduced the time a trade is hanging in limbo, which halves the risk and frees up capital.
Okay, so how does T+1 settlement dictate the X dividend date?
Because of this new lightning-fast settlement speed, the ex-dividend date is now mechanically set at exactly 1 business day before the record date.
Wait, let me deduce this. So who actually sets the X date? If the board of directors sets the declaration, record, and payable dates, does the board set the X date too?
Classic test misdirection. No. The board of directors sets declaration, record, and payable because those are internal corporate decisions. But the ex-dividend date is set by the exchange where the stock trades or by FINRA.
Wait, really? Why?
Because the X date is purely a mathematical function of market settlement rules, not corporate policy. The exchange looks at the record date the board picked and simply subtracts 1 business day based on the T+1 rule.
Okay, listener, direct question for you. Think through the logic we just laid out. Cautious Carl wants a dividend. The company announces that the X date is Tuesday, February 12th. Carl thinks to himself, the X date is the important date. I will buy the stock on the X date. So he logs in and buys the stock on Tuesday the 12th. Does Carl get the dividend? Give it a second.
Think about the timeline.
No, he absolutely does not. He gets nothing. What is the golden rule here?
The golden rule that you must memorize is this. You must buy before the X date to get the dividend. If you buy on or after the X date, you get nothing.
Explain the why for Carl so he understands why his account is empty. Walk through the days.
Let's track the T+1 settlement timeline. Carl buys the stock on Tuesday the 12th, which is the X date. The trade takes 1 full business day to settle. So Carl's money and the seller's shares don't officially swap hands until the end of the day on Wednesday the 13th.
Which happens to be the record date.
Right. But here is the catch. His trade settles at the end of the day on Wednesday. The company already finalized their shareholder ledger earlier that day. Carl missed the boat. The person who sold Carl the stock on Tuesday is still the official owner of record on Wednesday morning, so the seller gets the dividend.
Wow.
If Carl wanted to be on the books on Wednesday the 13th, he had to buy the stock by Monday the 11th. That way, the trade settles on Tuesday, and Carl is sitting comfortably on the ledger by Wednesday morning. Buy before the X date, always.
I'm going to push back on something here, because this looks really weird when you watch it happen live in the market. I'm looking at a hypothetical stock chart. The morning of the X date, the opening bell rings and the stock price just magically drops. If the dividend that was declared was exactly $1, the stock price artificially drops by $1 right on the open. Doesn't that mean the company just instantly lost a ton of fundamental value? Why am I, as a shareholder, being penalized?
You aren't being penalized at all. It is a strict mechanical market adjustment. Think about the logic of what is happening. Yesterday, the stock came with a golden ticket physically stapled to it, the legal right to receive a $1 cash dividend in the near future.
Okay, I like the golden ticket visual.
Today, on the X date, that golden ticket has been ripped off the stock. The stock no longer carries the right to that cash. Therefore, mathematically and logically, the stock is inherently worth exactly $1 less to a new buyer.
So it's not a capital loss.
No, it is absolutely not a decline in the company's fundamental business value. It is just the exchange automatically adjusting the opening price to reflect the reality that cash is actively leaving the corporate treasury and moving into the shareholders' pockets. If the exam asks you if the mandatory price drop on the X date creates a realized or unrealized capital loss, the answer is a hard no. It is a mechanical adjustment to keep the universe balanced.
DERP. Buy before the X date. T+1 settlement. Got it. Let's move to the next conceptual block, measuring the madness. We are going to look at yields, basis points, and what I call the bond seesaw. We know how income works. We know when it pays out. Now, how do we grade the performance? How do we mathematically measure if Discount Dave actually got a good deal on his investments? Let's start with the most basic metric, current yield.
Current yield is the simplest, most intuitive measure of return. The formula is annual income divided by current market price. If you are analyzing a stock, it is the annual dividend divided by the current stock price. If it is a bond, it is the annual coupon payment divided by the current bond price. It tells you the income return you are generating right now based on what the asset costs to buy today.
Okay, let's run the numbers. Discount Dave finds a bond that pays a $50 annual coupon. Because interest rates have gone up, the price of this older bond has dropped, and it is currently trading on the market at $900. $50 of income divided by a $900 price is 5.56%. That is Dave's current yield. But wait, test writers love this. Does current yield tell me my total comprehensive performance?
Absolutely not. Current yield has a massive blind spot. It only measures income. It completely ignores the other half of the return equation, which is capital gains or losses.
The realized and unrealized stuff.
Right. If a test question asks you to identify the formula for total performance or total return, and one of the multiple choice answers is current yield, cross it out immediately. It is a trap. Current yield doesn't care if Dave bought the bond at 900 and it is guaranteed to mature at 1,000. It only looks at the cash flow happening today.
So if current yield is only telling us half the story, we need a metric that tells the whole story. Enter yield to maturity, or YTM. This is where Discount Dave's strategy really shines. Dave buys a discount bond, meaning he bought it below its $1,000 par value. Let's stick with our example. Dave pays $900 for a bond that matures in 10 years. Why is his yield to maturity mathematically higher than his current yield? Let's build the seesaw.
This is the concept of the bond seesaw, and it's brilliant when you visualize it. Yield to maturity is a complex calculation that accounts for the annual coupon payments plus the annualized capital gain or loss you will experience when the bond inevitably matures at its par value.
Let's look at Dave's reality. Discount Dave paid $900. He is going to collect his $50 of interest every single year. But what happens in year 10 when the bond matures?
Think about what the company owes him.
The company that issued the bond doesn't give him his $900 back. They are legally obligated to hand him the full $1,000 par value. He gets a bonus.
Exactly. He gets a $100 capital gain built right into the structure of the bond. It is a guaranteed pull to par. Because he's receiving that extra $100 bonus at the end of the timeline, his true overall return, his yield to maturity, is mathematically pushed higher than his current yield and higher than his original coupon rate.
Okay, listener, let's do a side-by-side comparison for the test. You need to know the hierarchy of yields for a discount bond.
For a discount bond, the hierarchy from highest percentage to lowest percentage is always yield to maturity is the highest, followed by current yield, followed by the nominal coupon rate at the bottom. The built-in bonus of the discount pushes the total yield all the way up.
But what if Dave slipped on a banana peel, got confused, and accidentally overpaid? He bought a premium bond. He paid $1,100 for a bond that only has a par value of $1,000. What happens to the seesaw?
In that case, the seesaw tilts violently in the opposite direction. Dave overpaid. He is going to get his interest payments every year, which is nice. But when year 10 rolls around and the bond matures, the issuer is only legally required to give him $1,000 back. Dave suffers a guaranteed $100 capital loss.
Ouch.
Yeah, that massive penalty drags his total overall return down over the life of the bond.
So for a premium bond, the hierarchy of yields is completely reversed.
Exactly right. For a premium bond, the fixed coupon rate will be the highest number, followed by the current yield, and the yield to maturity will be the absolute lowest number because that capital loss is dragging the total return down to earth.
Okay, but let's throw a wrench into this. What if the company that issued the bond just decides to cancel the game early? They look at the current economic environment, they see the interest rates have dropped significantly, and they say, hey, we're paying too much interest on these old bonds. We are calling them in. Give them back.
This introduces a critical new metric you must know: yield to call, or YTC. This is crucial for analyzing callable bonds that are currently trading at a premium. Let's look at Dave's premium bond again. If Dave paid $1,100, he was planning to slowly absorb that $100 built-in loss over a long 10-year timeline. It hurts, but spread over 10 years, the annualized impact is small.
Right.
But if the company exercises their right to call the bond in after just 2 years...
Oh, wow. He takes the entire $100 hit almost instantly.
Precisely. He loses his premium over a drastically shorter time frame. He has fewer years to collect interest to offset that loss. Therefore, his annualized return completely plummets.
Your alarm bell should be ringing right here.
Yeah.
If you get a multiple choice question about a premium callable bond and it asks what the lowest possible yield the investor could experience is?
The lowest possible yield for a premium bond is always yield to call. It represents the absolute worst case scenario for an investor who bought at a premium. The exam loves testing that specific relationship. Premium bond. Yield to call is at the absolute bottom of the hierarchy.
Got it. So you have all these complex theoretical yields. But what is the ultimate scoreboard? When the year is over, how do I just know, bottom line, what I actually made in reality?
That is total return. It is the most comprehensive, undeniable measure of performance. The formula is beautifully simple. Total income received plus any capital gain or loss, all divided by your initial investment amount. It cuts through the theoretical noise and answers the ultimate question: how much did my wealth actually grow?
Total return is the undisputed king. Now, before we leave this section on measuring returns, I want to address some industry jargon. If you watch financial news, you hear people on Wall Street throwing around this term, basis points, or they call them bips. They say the Federal Reserve raised rates by 50 bips today. Why do they talk like that? Why can't highly educated economists just say percentages like normal people?
It's actually not to sound smart. It is to remove dangerous ambiguity from multi-billion-dollar conversations. A basis point is exactly 1/100th of 1%. So 100 basis points equals 1 full percent. 50 basis points is 0.50%.
Okay, but why do we need a new word for that?
Imagine you and I are negotiating a massive bond deal. I tell you current interest rates are at exactly 5%, and I expect them to go up by 1% next week. Does that mean I expect them to go up an absolute 1%, landing at 6%? Or does it mean I expect them to go up by 1% of the current 5%, which would only make them 5.05%?
Oh, in a fast-moving trading environment, that ambiguity could cost some millions of dollars.
Exactly. But if I look at you and say, rates went up 100 basis points, there is zero confusion. It strictly means they went from 5.00 to 6.00. It guarantees absolute mathematical precision when dealing with tiny numbers.
Boom. 100 bips equals 1%. Easy. All right, we're moving into the next phase. The tax man cometh. Cost basis, adjustments, and FIFO accounting. We've calculated exactly how much money we made. But unfortunately, Cautious Carl's absolute worst nightmare has arrived. The IRS has also been calculating your returns, and they care deeply, obsessively about your cost basis. Define cost basis for me in plain English.
Cost basis is simply the original historical value of your investment, strictly for tax purposes. It is the baseline from which all future gains and losses are measured. But here is the key detail for the exam. Your basis is your purchase price, plus any commissions and fees you paid to acquire the asset.
Oh, commissions count.
Yes. For example, if you buy 100 shares at $50 a share, the core price is $5,000. But if you paid a $10 commission to your broker to execute the trade...
My legal cost basis is $5,010.
Correct. The IRS allows you to roll the fee into your cost. And this actually helps you because a higher cost basis slightly reduces your taxable capital gain when you eventually sell the asset.
All right, but here's the problem. Cost basis rarely stays the same over a 10-year holding period. Things happen to the company. Corporate actions occur. I call these the 4 horsemen of tax math. I am going to throw rapid-fire scenarios at you involving cautious Carl. You tell me what happens to Carl's total aggregate cost basis and his per-share basis. You ready?
Ready. Let's do the math.
Scenario 1, a traditional stock split. Carl has 100 shares, and his total basis is $5,000. The company announces a 2-for-1 split.
Total overall basis stays exactly the same at $5,000. He didn't gain or lose any real wealth. However, he now has 200 shares instead of 100. So his per-share basis mathematically decreases from $50 down to $25.
Scenario 2, a stock dividend.
The mechanics are identical to a stock split. Total basis stays exactly the same. Per-share basis decreases because he has more shares spread over the same total cost.
Scenario 3, return of capital. Carl's MLP sends him a check for $1,000 of his own money back.
The whole pie physically shrinks. His total aggregate basis decreases from $5,000 down to $4,000. His capital at risk has been reduced.
Scenario 4, reinvested dividends. Carl gets a cash dividend of $500. But instead of taking the check to the bank, Carl previously checked a box on his brokerage account that automatically uses that cash to buy more fractional shares of the same exact stock. What happens to his basis?
This is the one that catches everyone on the exam. Reinvested dividends increase your total cost basis.
Wait, pause. Why? That feels instinctively punishing to the investor. I didn't even touch the cash. It never hit my checking account.
I know it feels counterintuitive, but you have to think about what is legally happening behind the scenes. The company legally paid you a cash dividend. That is a taxable income event this year. You owe taxes on that $500 right now.
Okay.
Then, milliseconds later, the broker took that after-tax money and bought more shares on the open market for you. You effectively added new, fresh money to the investment. Because you already paid taxes on that dividend income this year, the IRS lets you increase your cost basis. If they didn't let you increase your basis, what would happen when you eventually sold the stock a decade later?
I would have a larger capital gain, which means I would be taxed on that same $500 twice.
Exactly. It is actually a taxpayer protection mechanism. It saves you from double taxation. Your basis goes up, which lowers your future capital gain.
Okay, so that makes logical sense when you break it down.
Sure.
Reinvested dividends increase your total cost basis. Now, what about the complexities of selling mutual funds? Carl's been aggressively saving. He's been buying 50 shares of a specific mutual fund every single month for 3 years. He's got shares from January that he bought at $20, shares from June at $30, shares from November at $40.
A lot of different tax lots.
Yeah. Suddenly, his roof caves in and he needs cash immediately. He clicks sell on 50 shares. Which specific shares did he just sell?
This is a massive tax accounting question. Because the shares were all bought at different prices, the capital gain impact is entirely dependent on which shares are sold. The IRS has a strict default method if you do not specifically give your broker instructions prior to the trade. The default method is FIFO, first in, first out.
First in, first out, FIFO. This is highly testable.
Exactly. If Carl hits sell and says absolutely nothing else, the IRS legally assumes he sold the absolute oldest shares he owned first. In your example, the system will automatically assume he sold the January shares that he originally bought at $20.
But wait, let's look at the math there. If he is selling those 50 shares today and the market price is currently $50 a share and the IRS forcefully pits the January shares with a $20 basis, Carl has a huge $30 per share capital gain. He is going to owe a ton of tax this year. What if he wanted to sell the November shares that he bought at $40? Then his taxable gain is only $10 a share. He would save a fortune in taxes.
If Carl wants to strategically minimize his tax burden like that, he must use the specific identification accounting method. This gives the investor maximum control over their tax destiny. But the massive catch is he must identify those specific shares at the time of the sale. He has to tell the broker, sell the November lot. He absolutely cannot wait until tax season in April, look at his tax bill and say, oh yeah, IRS, I actually meant to sell the November ones.
Too late, Carl. You got FIFO'd. Your lack of planning cost you. Is there a middle ground for people who don't want to micromanage every single lot of shares?
Yes, and it is called the average cost method. You literally just take the the total cumulative cost of every single share you have ever bought, divided by the total number of shares you currently own, and that resulting average price becomes your universal cost basis for every single share you sell from that point forward. It is the simplest calculation, it smooths out market volatility, and it is overwhelmingly the most common method used by retail investors for mutual funds.
Okay, this sounds like an absolute record-keeping nightmare. Imagine doing this for decades. Is Carl sitting at his kitchen table under a dim light bulb with a dusty calculator trying to track the basis of every dividend he reinvested since 1998?
He used to have to, and it was a disaster.
Yeah.
Think about the tax implications. If an investor lied or just honestly lost their paperwork and guessed their cost basis, the IRS was losing billions of dollars in what they called the tax gap. It was essentially an honor system. So the government finally stepped in and created broker-dealer reporting requirements.
Thank goodness.
Now, modern brokers are legally required to calculate the exact cost basis for you and report it directly to the IRS on Form 1099-B. But this only applies to what the law calls covered securities.
What exactly makes a security covered? Is it a specific type of asset?
It is entirely based on the date of acquisition. The IRS didn't want to force brokers to dig through 30 years of paper records, so they rolled the rule out in phases moving forward. Here are the dates you need to know. Stocks acquired on or after January 1st, 2011 are covered. Mutual funds and ETFs acquired on or after January 1st, 2012 are covered. Bonds and complex options acquired on or after January 1st, 2014 are covered.
So 2011, 2012, 2014, why were bonds so late?
They rolled bonds out last because bond math, with premium amortization and discount accretion, is incredibly complex for brokers to program. If you bought an asset before those dates, they are considered non-covered. The broker doesn't have to report the basis, and Carl better hope he can find his old spreadsheets in the attic.
2011 for stocks, 2012 for funds, 2014 for bonds. That progression makes total sense when you explain the complexity of bond math.
Got it. Moving to our final major segment, scoreboards and teams' benchmarks and indices. So, Dolores did all the math. She calculated her total return after taxes. She made an 8% return this year. She is thrilled. She is popping champagne. But is an 8% return actually good?
You cannot possibly know the answer to that in a vacuum. 8% sounds great compared to a bank account. But what if the overall stock market went up 20% that same year? If that is the case, Dolores actually did terribly. She dramatically underperformed the market. You need a standard to compare your performance against.
Which brings us to the conceptual difference between an index and a benchmark. People throw these words around interchangeably on television, but they're not exactly the same thing. Right. An index is purely a statistical measure. It is a strict mathematical calculation of the performance of a specific group of securities. A benchmark, on the other hand, is the standard you choose to use as your comparison to judge your own success. Most benchmarks are indices, but the term benchmark refers to the role that index is playing for you.
Let's look at the heavyweights, the biggest indices out there. Everyone knows the S&P 500. It tracks roughly 500 large U.S. publicly traded stocks. But how is the math actually built behind the scenes?
The S&P 500 is what we call market cap weighted. This is absolutely critical for the exam. Market capitalization means the total overall value of the company. You take the current share price and multiply it by the total number of outstanding shares. In a market cap weighted index, the largest, most valuable companies physically have the most mathematical influence over the daily movement of the index.
So an absolute monster of a company like Apple, with a $3 trillion market cap, moves the needle of the S&P 500 way, way more than a company at the bottom of the list that is only worth $10 billion.
Exactly. If Apple goes up 2% on a random Tuesday, its sheer size pulls the entire S&P 500 index up with it. Conversely, if that tiny $10 billion company cures a disease and goes up 50% in one day, the overall S&P 500 barely flinches because that company's weight in the index is mathematically microscopic.
Now contrast that with the other famous index you hear on the nightly news, the Dow. The Dow Jones Industrial Average, or DJIA, It only tracks 30 large stocks. But it is not market cap weighted, is it?
It is not. The Dow is price weighted. This means the absolute dollar price of a single share of stock determines its total influence over the index. The total size of the company is completely ignored.
Wait, let me make sure I'm understanding the absurdity of this. Are you telling me the stock trading at $200 a share has 10 times the mathematical influence over the Dow as a stock trading at $20 a share? Even if the $20 company is 10 times larger in total real-world value.
That is exactly what I'm telling you. It is a mathematically antiquated system created in the late 1800s before computers existed, but because it is the oldest index, the media still heavily quotes it. But here is the massive test implication that stems from this flawed math. What happens if a high-priced stock in the Dow executes a stock split?
Oh, let's think about this. If that $200 stock does a 2-for-1 split, its per share price instantly drops to $100.
Right. And because the Dow is purely a price-weighted index, that stock just instantly lost half of its mathematical influence over the daily movement of the Dow, even though the underlying company's total fundamental value, its earnings, and its market cap didn't change by a single penny. A simple corporate stock split severely hurts a company's influence in the Dow. This is why a massive company like Amazon wasn't added to the Dow for years. Its share price was thousands of dollars, and if they added it, Amazon would have dictated the entire index single-handedly.
What about a stock split in the S&P 500? Does that hurt the company's standing?
It does absolutely nothing to the weighting. Because a stock split just changes the number of slices, it doesn't change the total market cap of the pizza. The S&P 500 only cares about the total market cap, so a split is a non-event for index weighting.
Okay, that is a beautiful, highly testable distinction. Let's hit a few other gotcha indices that might pop up. The Russell 2000. It tracks the 2,000 largest companies in America, right?
That is a classic trap. No. The Russell 2000 is the primary benchmark for small-cap stocks. The name refers to the bottom 2,000 companies of the broader Russell 3000 index. It is the definitive small-cap index. Do not let the big number 2,000 fool you into thinking it means large companies.
What about our friend Discount Dave? He is a bond guy. Does Dave benchmark his bond portfolio against the Dow Jones?
No, the DJIA and S&P 500 are exclusively for equity stocks. If Dave wants to benchmark his U.S. investment-grade bonds, the go-to standard is the Bloomberg Aggregate Bond Index, often just called the AG.
And if I don't want to pick large cap or small cap or bonds, if I just want to measure the total market, literally everything,
you would look at the Wilshire 5000. It is essentially the broadest measure of the entire U.S. equity market.
Okay, I have one last major conceptual hurdle here before we wrap. You explained the S&P 500 beautifully. I believe in American large cap companies. I want to buy it. I call my broker right now and say, take $10,000 out of my account and buy me the S&P 500 index.
Your broker will laugh and then tell you that is physically impossible.
Why? I see the S&P 500 ticker on the screen right now.
Because you cannot invest directly into an index. An index is just a mathematical calculation running on a computer server at Standard & Poor's. It is an imaginary, theoretical portfolio used to track data.
Think of it this way. An index is the giant digital scoreboard at a football stadium. The scoreboard just displays numbers indicating how the game is going. You cannot put on a helmet, run onto the field, and try to tackle the scoreboard. It's just math and light bulbs. If you want to participate in the game, you have to buy a team.
That is a phenomenal analogy. The team you buy is an index fund or an ETF and exchange traded fund. These are actual physical investment products created by asset management companies like Vanguard, State Street, or BlackRock. They take your $10,000 and they go out into the real open market and physically buy the exact 500 stocks in the exact market cap proportions that the theoretical S&P 500 scoreboard dictates. They are actively trying to mimic the index.
But because they are real-world funds operating in a messy reality, they aren't completely perfect reflections of the scoreboard, right?
Correct. The theoretical scoreboard has zero expenses. It doesn't pay trading commissions or employee salaries. Real-world funds have management fees, transaction costs, and they have to hold a little bit of dead cash to handle daily investor redemptions. This friction creates what we call tracking error. Over time, an index fund will always return slightly less than the pure index itself because of those real-world frictions dragging it down.
You cannot buy the scoreboard. You have to buy a team that tracks the scoreboard. I love that. All right, we have covered an immense amount of ground today. We went deep into the mechanics. It is time for our rapid-fire recap. I want high-energy, alternating bullet points. We are summarizing the absolute deadliest exam traps we discussed today. You ready?
Let's do it.
Number 1, unrealized gains are just paper gains. If a question gives you a wild story about a stock skyrocketing, but the investor didn't actually hit the sell button, their realized gain is strictly zero. No tax until you sell.
Number 2, return of capital is not income. It is the company handing your own money back to you, which lowers your cost basis. Once that basis mathematically hits zero, any further distributions you receive are instantly taxed as capital gains.
Number 3, the golden X-date rule, DERP. If you buy on the X-dividend date, you get NO dividend. You must buy before the X-date to be on the books. And remember the trick. The X-date is set by FINRA or the exchange based on T+1 settlement rules. It is not set by the board of directors.
Number 4, The yield seesaw. For a discount bond, the yield to maturity is pulled higher than the coupon rate. For a premium callable bond, the lowest, absolute worst-case yield is always the yield to call.
Number 5. The IRS default method for selling mutual fund shares when you don't give instructions is FIFO. First in, first out. If cautious Carl wants to pick specific shares to lower his taxes, he must identify them at the exact time of the sale. And do not forget, reinvested dividends legally increase your cost basis to prevent you from suffering double taxation.
Number 6. The DJIA is price-weighted, meaning a simple stock split severely reduces that company's influence in the index. The S&P 500 is market cap-weighted. And finally, you cannot invest directly in an index. You must buy a mutual fund or ETF that tracks it.
Boom. That is exactly what you need to conceptually understand to crush this section of the SIE. Now, before we sign off, I always like to throw it over to our expert for a final provocative thought, something to chew on that goes a little beyond the black and white textbook rules. What do you have for us today?
We have spent all this time today talking about measuring past returns and comparing performance against indices like the S&P 500. Millions of people, quite reasonably, just buy passive index funds now because they mathematically work. But think about the macro implications of this. An index is essentially a rearview mirror. An index fund just blindly buys the biggest companies based on what already worked in the past. If passive index funds continue to grow and eventually every single investor in the world just blindly buys the index and stops actively researching and picking stocks, who is left to figure out what the prices of those stocks should actually be in the first place? If nobody is doing the hard research to buy and sell individual companies based on their true value, the entire price discovery mechanism of the free market breaks down. Something to chew on as you prep for the exam.
That is wild to think about. A multi-trillion-dollar market completely on autopilot with absolutely no one actually steering the ship. I love it. All right, listener, you have the tools. You understand the murky waters, the x-rays, the pizzas, the seesaws, and the scoreboards. Go take a breath, review these concepts, and you are going to absolutely dominate the investment return section of the SIE. Keep studying, and we will see you on the next deep dive.